Today, we're going to analyze Alldigi Tech Limited's latest earnings conference call, also known as its Concall. If you don't know what's a Concall, basically the management of the company meets with the shareholders of the company. They have a meeting, could be physical, could be online. The shareholders ask questions about the business, the latest earnings, and what else, and the management gives the answers. So today, we're going to analyze this Concall and try to find out what the management says are the business's growth targets, like how fast they want to grow the revenue, and the profit targets and the profit margin targets. Okay, so let us start. We will also get some more information about the company. All right, so we are reading whatever is being highlighted. We also continue to grow the international business, with it contributing 76% of the total business on a half yearly basis, up from 72% last year. All right, so the company is truly global. 76% of total business on a half yearly basis came this half year. Half year means 2 quarters combined. So this was H1 of fiscal year 2026, first half. So quarter one plus quarter two revenues combined, 76% came from internationally, up from 72% the last half year. Okay, now let us continue. Where is it? Where is it? Yes. So again, reading what has been highlighted, okay? The tech and digital margins. So tech and digital, and then I think the customer experience management. So the tech and digital business segment of Alldigi Tech, this is the more profitable one. So the tech and digital business, their profit margins touched almost 40% in quarter two of fiscal year 2026. So the EBITDA margins of the tech and digital business touched almost 40%. Okay. And they expect the margins to again come back at least to where we were at the end of quarter four fiscal year 2025, which is in the 41 to 42% range for the next quarter, quarter three. So quarter three fiscal year 2026, they're expecting EBITDA margins for the tech and digital business to be around 41 to 42%. So that is a slight increase from quarter two earnings or quarter two margins. So that's good. Moving on, we move to another page. Now, margin guidance, guidance on margin. Okay. The guidance on the margin side, I've said this in the past that on year on year basis, we look to be able to improve our EBITDA margins anywhere between 1 to 1.5%. And I don't see any significant challenge in achieving that. So they want to increase the EBITDA margins by 1 to 1.5%, the overall business, not just tech and digital, but the overall business. So, for example, let's say last year margins were overall 24%. They want to improve by 1 to 1.5%. So they want to grow from 24% to 25% or 25.5% EBITDA margin is what they want to achieve. Then this 100 to 150 basis points margin improvement. 100 to 150 basis point is the same as 1 to 1.5 percentage points. How are they looking to achieve it? Okay. So this will be a mix of a couple of things. Three things actually, largely three drivers. One is for both the BPO, the business process outsourcing, and the HR or the human resources business. Growing our share of the international revenues is a key part of the strategy. So, growing the share of international revenue in the business, continuing, and we have demonstrated our ability to do that consistently again over the last 10 quarters. Okay, so that would be an important part where our higher margin businesses are the international business within BPO and doing more of the international business within the HRO, human resources outsourcing, will be a key part of the strategy. So, the first part of the strategy to grow their margins is that in the business process outsourcing and the human resources outsourcing division is to have larger share of international business. Then, second, Second would be the focus on operational efficiencies, and that is more relevant to the payroll business, where we have been tracking a metric called employee records per employee in terms of how many payroll records an employee can process. So in the payroll business, they're getting paid or how many payrolls they can process, how many employees they can make sure get paid on time, all the payments, international employees getting paid, all the complex stuff, it gets done on time. So how many payroll records one employee can process. So, payroll records per employee, they're trying to improve the revenue generated from per employee and the efficiency of per employee. Continuing to read, and there too, we have demonstrated a 2 to 3% quarter on quarter, meaning every quarter 2 to 3%, and a 5 to 6% year on year improvement. So, that is the second contribution to margin improvement. So employees are becoming more efficient, able to handle more business. And finally, this. And the third component is, of course, tighter control on overall costs, indirect costs. And as the revenues grow, that itself gives a bit of an uplift because we ensure that we don't increase the indirect costs in proportion to the revenues. All right, controlling the costs such that as in the future, let's say revenues rise by 15%, just saying revenues rise by 15%. So costs hopefully rise by less than 15%, 14, 13, 12%, something like that, hypothetical, that will improve margins. Then, other page. Now, this is pretty important. This is a pretty long-term vision of the EXM business. EXM is Employee Experience Management. This is also a pretty big business. I think this is the tech and digital one. Wait, hold up. Which is the tech and digital one? I've forgotten. Okay. I would say we could double our employee experience management business over the next, let's say, 4 to 5 years. Next 4 to 5 years, doubling the employee experience management business. Now, let me see if it's clear. Yes. The pacing of it within the 5 years, of course, would depend on a lot of things in terms of how the economy does, what our competition do, and we are very mindful of that in terms of keeping a close eye on all of that. But yes, we believe that we will continue to grow on a CAGR of in the high teens, and I don't see a challenge in that. That can only accelerate. But as a baseline, I don't see a challenge in growing in the high teens year on year. So, as a baseline, as like a minimum, the company says they don't see a challenge in achieving high teens of growth. What is high teens? High teens is somewhere around, I believe, 15 to 19% revenue growth, isn't I think high teens. Or like 16 to 19% revenue growth, 17 to 19% revenue growth is the high teens. And they're taking that as base. So just shy of 20% revenue growth is what they're looking for as not as a challenge. Pretty easy, achievable stuff. So very interesting. Let's see if they can achieve that. This quarter wasn't the highest growth, but they're saying that overall, like quarter two can be slow. Quarter one, let's say, was slow. So quarter three and quarter four will grow at such a pace that the year quarter one to quarter four combined will grow around 16 to 19% at high teens growth. So overall, he's saying, okay, or they are saying, sorry, they are saying. Continuing to read. Looking at our pipeline, looking at the investments we have made, we believe that we should continue to be in the mid to high teens, which is what, and as you rightly remember, I was consistently saying this. I have not, I have not been changing our position. So I will continue to hold on. We will continue to grow in the mid to high teens on an annualized basis. So mid to high teens, okay, mid to high teens, 14 to 19%, 15 to 19%, mid to high teens, okay, and they have made investments. If you mean, if you want to know what does pipeline mean, I think it means that the orders from customers. Pipeline is the process, like a literal pipe. So the process on how to get orders from customers, engaging with customer, talking to a customer, phoning a customer, talking with them and finally getting them to buy. There's a pipe, an entire process to get a customer. That's the pipeline. And I think yes, a question has been asked, a very interesting question. Any specific reason why the depreciation on a year-on-year basis has gone up by almost 50% from 10 crores to 15 crores this quarter. Good question. Why has depreciation gone up 50% to like 15 crores a quarter? Okay, big thing. This can very much impact profitability. So answer is there has been a significant investments in the Bangalore facility and a right of use assets have grown, which you would have seen. Also, there was a significant investment for infrastructure upgrade for one of our leading clients in tech and digital. And then, of course, there are routine capex requirements in terms of your replacements to your laptops, desktop, etc. Yeah, continuing to read, all those things are there. So, from that point of view, depreciation has come to this run rate, and I think it should remain roughly there unless there will be some other capital expenditure requirements which will come up in the future. Okay, so these are some capital requirements. One was Bangalore facility, one was another infrastructure upgrade for one of the clients, and one was routine expenditures. So he's saying that it should, so the company is saying this depreciation amount should roughly be in here. So like 15, 16 crores to be the rough depreciation, unless there's some other routine capex coming up. Okay, 15 crores ish is a depreciation that we could be looking at. And finally, as a final reminder, this is the last statement. We will continue to grow revenue in mid to high teens. We will continue to endeavor to add anywhere between 100 to 150 basis points to our EBITDA margins even going forward. So whatever EBITDA margins the company posted right now, 24%-ish, they want to add 1% to 1.5 percentage points to that, and of course, growing revenue mid to high teens. That is it. That was the entire Concall analysis. Maybe there are more important things, but we will only discuss this for now. That is it. Bye.